Good morning, everybody. Thanks very much for joining us. Really interesting session this morning, which is looking at Iberia, and also looking at, I suppose, why people should be looking at Iberia now. What are the challenges in the market? What's the outlook? But key to this is where are the opportunities? For those who don't know me, my name is Richard Betts. I'm the group publisher at Real Asset Media. We publish a series of newsletters and magazines, do TV interviews, as well as around 60 of these events a year. These are the magazines. Feel free to take a look at them on the website whenever you can. We've also been producing a lot of new initiatives, including Realcast, special reports, and as well as moving these events online so that everybody can keep connected during the crisis. We're also launching another new initiative, which is called RealX Global, which is going to be a global trade fair and conference, which launches 17th of 18th of September. And there'll be more news coming out on that later. I'm delighted here to be working with our friends at Iberian Property, Arturo and Antonio. You'll meet Antonio shortly. Just wanted to introduce very briefly the speakers. So if all of the speakers can now put your cameras on and introduce yourselves, that would be great. But we have José Manuel Llovet from Grupo, Pedro Coelho from Square Asset Management, Cristina García-Peri from Azora, Simon Wallace from DWS, and last but very not least, Maria Jesus Fernandez from ISEX Invest in Spain. So let's start with you, Jose. Just give a very kind of brief introduction of yourself and the company so that then everybody knows exactly who everybody else is.
First, to say that I hope that all the attendants are okay and their families are okay, and they keep on being responsible and taking care of themselves in the coming months. My name, as Richard said, I am José Manuel Llovet. I am Managing Director of Commercial Real Estate in Grupo. I've been in this sector for 25 years now, in different companies, in international environment, and in a company that today has 50 years. We are managing a volume of around 4 billion euros in 7 countries in the world, and we are, trying to provide the best investment management services to the international capital.
Great, thanks very much. Pedro.
My name is Pedro Coelho. I'm the CEO and founding partner of Square Asset Management, the largest independent asset manager in Portugal. We manage about 1.4 billion euros of retail and institutional investors, and the largest fund in Portugal, which is 800 million euros NAV without leverage.
Super, thanks very much. Cristina.
My name is Cristina García-Peri. I'm one of the senior partners of Azora. Azora is a private equity manager, very much focused on real assets and very much focused on real estate, based in Spain, although we invest globally, but we do invest and have invested mostly in the Iberian market. Overall, we have raised roughly 3.5 billion of equity from institutional investors, both domestic and international, having managed close to 7 billion of assets. As I said, mainly real estate. We focus on alternative assets for the most part. So looking forward to sharing with you how we see the market and where we see the opportunities. Thank you.
That's great. Thanks very much. Simon.
Simon Wallace. I'm the Global Head of Research at DWS. DWS, we are a global asset manager. We're active across all of the major markets and all sectors.
Super. Thanks very much. Maria Jesus.
Hi, Richard. Thank you, Iberian Property, for the invitation. I am Maria Jesus Fernandez. I'm the Executive Director of ISEX Invest in Spain. And for those of you who are not well acquainted with us, let me just say that we are a governmental agency under the Ministry of Industry, Trade and Tourism, dedicated to supporting the Spanish companies in their internationalization process. And also, we are dedicated to attracting foreign direct investment. And that's precisely what we do at Invest in Spain. The way we do it, basically, by providing international investors like you guys with a advise on a wide array of issues that are going to be key in your decision-making process. And referring to taxes, labor market regulation, incentive packages. So basically what we try to do is to facilitate and accelerate your decision-making process. And once you've made the decision to open a shop in Spain, we help you soft land. We help you get in touch with the different institutions you will have to work with. We help you get acquainted with the different procedures you will have to comply with. And we advise you on the pace and sequence of the tax you will have to perform. And that's basically what we do. Thank you.
That's great. And we're going to come to a presentation from you in a second, Maria, and then Simon. But first, António, just give a brief introduction of yourself and Iberian Property, if you could. And thanks very much again for working with us. It's always a pleasure to work with Iberian Property.
My name is António Machado. I run Iberian Property as a part of one of the major editorial groups in Portugal and Spain. We publish 4 magazines. We have data, we run conferences, and we are the get-together of the Iberian community. Many thanks for sharing with us.
Super. So Maria, you're going to give a presentation just briefly on this. So if you share your screen, that would be great.
Let me get right into the presentation, and starting by the obvious. It is already pretty clear by now that the world economy is facing a crisis of an unprecedented severity and a scale. First of all, it is an external shock that has nothing to do with inherent workings of the economies. And that's a very important point. Second point, it is a global crisis, but with uneven effects across countries. And these 2 points taken together unquestionably call for an international coordinated response, particularly within the EU. So that's why our authorities, the Spanish authorities, together with the rest of the European Union, is working towards this end. Is working to put in place a coordinated response, commensurate to the challenge we have before us. But time is of the essence. So this package has to be put in place very soon, just to make sure that the recovery we have is of a nice V shape, or as close as a nice V shape that we can have. So, as I believe that these 2 points are paramount, I'd like to elaborate a little bit on them and refer to the Spanish economy. Because as I was saying, this is a shock that has nothing to do with the track record of good economic policies and reforms that Spain had put in place and that had made possible that the economy be placed as for the last few years, the fastest growing economy among the largest economies in the Eurozone. And not only that, Spain has been for the last 6 years the second fastest growing economies among the world's advanced economies after the US. And this is a very important point. For the last few years, you guys, investors, have been seeing how strongly the Spanish economy had been sustaining an economic expansion that was going along with a strong job creation and large competitive gains. And if I had to pick one point that really symbolizes the unparalleled turnaround that Spain had been experiencing for the last few years, is precisely these large competitive gains. We closed 2019 with a current account surplus for the 7th consecutive year. 6 of those years coinciding with positive GDP growth rates. And believe me that this is pretty unheard of in the Spanish economy in recent history. You can also see our increasing competitiveness by looking at the upward trend followed by the weight that our experts have in our GDP, going from nearly 22% in 2009 to nearly 34% in 2019. Huge upward trend follow. And you can also see the increase in our competitiveness by looking at the real unit labor cost have been performing for the last few years. And we had also done a lot to reduce our unemployment, and we had the private sector had done tremendously well to reduce its leverage, more than 72 percentage points of our GDP, and also the public sector had reduced its fiscal deficit more than 8 percentage points. Of course, we know that we had our challenges, debt high, but we had done a lot. And there it came COVID and the need to take very severe measures to contain the virus. Spain had to take very severe measures, and that's why you are seeing that tremendous drop in our GDP growth rate projected for this year. Another very important reason that explains why you are seeing such a drop in the case of Spain is that, as I was saying, this is a global crisis. Everything has been affected. Global demand, global value chains, industrial production, commodities, investment flows, but there are sectors that have been more affected than others. And in the case of Spain, we have transportation, we have the automotive sector, we have tourism, and those are sectors that are strategic, that have a very important weight in our GDP, and that have been particularly hit. That's why, again, it is paramount, it is of the essence that we have a commensurate package of a coordinated response at the EU level. And again, we are working towards that end. Of course, putting in numbers the impact that the COVID is having, well, it's very difficult because uncertainty is still the name of the game. But you can see the forecast by the European Commission, the IMF. So for Spain, a drop at the IMF is projecting 8% a drop this year, the European Commission 9.4%. Similar really to Italy, 9.5, 9.1, France 7.2, 8.2. So really, we're all in a very profound ditch. But provided that the measures that are being taken are effective, provided that we have this coordinated international response, provided that the economy starts recovering, we are projecting a very strong GDP growth for 2021. In the case of Spain, the European Commission is projecting a positive GDP growth of 7%, for Italy 6.5%, for France 7.4%, for Germany 5.9%. We have to be encouraged by the measures that have been taken, because all governments, and the Spanish government, particularly because that's what I know better, has been responding swiftly and in the right direction. How? First of all, ensuring that companies stay afloat, protecting companies, providing the liquidity they needed, again, to stay afloat, with guarantees, with moratoriums in their tax collection, in security, in social security contributions. So protecting companies, very important point. Second type of measures, minimize the impact on employment by simplifying the furlough procedures, by providing access to full social benefits for layoff workers, by extending social security allowances. So again, for us, protecting employment was very, very important. And third type of measures, again, key, protect the most vulnerable with mortgages moratorium, but also for other type of credits that families had. Electricity, reduced price, freezing butane cylinder price. So protecting the most vulnerable was also a key point for us. Of course, this is going to have a huge impact on our public finances, more than 14 or nearly 14% in terms of our GDP, but very similar to what other countries will also have to face. But it was absolutely paramount and it was indispensable. Fiscal policy had to be the first line of defense to prevent the potential long-term impact of this temporary lockdown of economic activity. Fiscal policy was very important, but also the central banks, and particularly the European Central Bank, they had to make sure that the markets continue functioning correctly and that we have access to financing in good conditions, in good terms. With all these measures, we are seeing that as lockdown easing is progressing, there are signs of economic recovery. We've seen in some indexes like purchasing managers index or some confidence indicators, but we also see it in electricity consumption, in mobility and credit card spending, and also in social security registrations. We have last month, we had more than 200,000 members joining again, and up to now, this month, we have already more than 400 workers temporarily laid off that have come back to their workplaces. So let's hope for the best. A lot of uncertainty, but we believe that the measures taken have been swift and in the right direction. Moving forward, we have specific plans to support strategic sectors like the automotive sector with a plan of over 3.7 billion euros for renewing the fleet towards ecological transition, to promote investment, to boost competitiveness, to promote research and development. Also tourism, very important, with a very important package of support. And another very important piece in making sure that Spain regains its path of economic growth is the ecological transition. And I guess that this offers you guys a lot of opportunity. All of these pieces offer a lot of opportunities for you guys to invest in our country, but particularly this ecological transition that promotes the efficient use of energy and use of renewable sources of energy, and that has as a very important part in the equation the rebuilding and reusing of existing buildings, which deliver significant commercial and social returns. The initial government's commitment is to rehabilitate up to 1.2 million homes and generate 70% of the electricity from renewables by 2030. So I guess this is a nice door that it's open and that provides opportunities again for investors in your realm of activity. Digital transportation, a lot of employment, training for employment, vocational and for digital, and also, again, very important part, the investment that we will have on research and development. All of this will accompany the reconstruction process that will have also a lot of elimination of barriers, facilitation of procedures, precisely, and that's a very important point, precisely to encourage you guys to invest productively in our country. We are waiting for you in Spain, as we have seen that you've come for the last few years, and you can see the upward trend follow, but foreign direct investment for the last few years in our country. Record numbers, 2018, a record high. Never before had Spain received such a huge amount of foreign direct investment, more than 56 billion. 2018 wasn't as good, but 2019 was pretty challenging as well, and foreign direct investment dropped by more than 15%. So we got the hit as well. But 24 billion is a pretty large amount. Actually, it's the ninth highest amount that we got since we have records. So for the last few years, Spain not only have been receiving a lot of foreign direct investment, but and this includes M&A, but also very important greenfield projects. Spain in 2018 was the third largest recipient of greenfield projects in the European Union, with more than 21 billion in capex. And this was not just a one-time stance. If we take a longer period, you can see in the last 5 years how Spain has consistently been the second largest recipient of greenfield projects in Europe, more than 93 billion, and in more than 3,100 projects. And in 2018, and I was referring that maybe the amount that we received in 2019 wasn't as large, but it was very important in terms of the type of projects we were receiving. In 2019, Spain was the world's 6th largest recipient of greenfield projects in the world, and not of any greenfield project. Spain was the 5th largest recipient of greenfield projects with a lot of innovation and high-end technology. And this is critical for our competitiveness. So Spain is still attractive, and we cannot see how this COVID-19 crisis washes away all the progress that we have attained for the last few years. You can see real estate, building and infrastructure, how important it is in terms of stock and the important amounts that we've received of foreign direct investment in this sector, and the type of operations that we've seen for the last few years, not only driven by the real estate assets that financial institutions had in their balance sheet, but also hotels, and also 3 very important sectors where we see nice dynamic in the Spanish sector, or that we have seen up to now, and that we are sure that we will continue seeing opportunities in the senior residences, student residence, and logistics. So we wait you in Spain. Spain is open for business, and as I said, we are an open, competitive country that have done a lot. With your help, foreign direct investment has to be one of the most important levers to get us out of this ditch. Thank you so much.
Thanks very much, Maria Jesus. Some really interesting things there, I think, especially looking at some of those things around the Purchase Managers Index, and I saw the credit card spending was beginning to go up again, which I think is encouraging, especially here in the UK. We're now going to pick up with Simon. Simon, hopefully you're seeing your slides there.
I am indeed, yeah.
Excellent, very good.
I'm conscious I'm the only member of the panel here that is sat in London and not sat in Iberia, and unsurprisingly, with the lockdown, it has been a few months since I've been in Spain and Portugal. It was in February, but thankfully we do have a very good team based out of Madrid, led by Daniel Galvez, and I think importantly, we are still active in the Iberian market. We have a number of ongoing deals in multiple locations and multiple sectors over in the market. I think my overriding sort of message from this sort of short presentation that I'm going to give about our outlook for the Iberian market is one of cautious optimism. I think in terms of the optimism, we had a number of points from Maria Jesus there, which we fully agree with. One, that this is an event-driven recession. This is not the financial crisis. We're seeing the easing of lockdown. We've seen the rallying of global equity markets and global debt markets, and certainly the interventions from government and central banks have been unprecedented. You know, compare this to the financial crisis. Government, central banks, they've moved far further and far more quickly than anything we were seeing in 2008 and 2009. I think from a real estate perspective, though, this is the important part. Fundamentals today are far better than what we are seeing in the financial crisis. So I think the Iberian market is a great example of this. If we look at the level of oversupply and overbuild that was going on in Iberia ahead of and going into the financial crisis, it is starkly different today. Yes, there's been a pickup in development over recent years in Iberia, but nothing compared to what we were seeing in 2008, 2009. So we don't expect a huge increase in vacancy that we were seeing in the financial crisis. So I think that's the area of optimism for us. But it is important today that we remain cautious. I think we have to accept that this crisis is not over. It sometimes feels like things are getting much better, and in many ways they are. But we've got to look globally as well. The likes of Spain and Portugal, these are open international economies. And when you look at, say, the rapid increase in cases of CV-19 in places like South America, for example, and the ongoing levels of infections in say, North America and others, then this will continue to have a bearing upon economic activity. So I think our central case also is that we would expect a second wave of CV-19 in any markets. We wouldn't expect as severe a lockdown, and we wouldn't expect as much disruption as we've seen over the past 3 months, but nonetheless, we should still remain cautious about the ongoing economic impact. And I think importantly as well, we do expect to see further levels of, further increases in unemployment. I think we've got to remember across the 5 largest economies in Europe, so that's the UK, France, Germany, Spain, and Italy. By the end of May, we still had 45 million people who were covered by some sort of furlough scheme. So as those schemes start to be unwound, there is a high probability that we will see more unemployment, and that will have an impact upon the real estate market. If we turn to my first slide, what you can see here is that these are our expectations for capital value decline. This is at a European level. So these are our latest forecasts for capital values in 2020, the change in 2020 by sector at the sort of European average level. And what you can see here, look, on average, we are expecting value decline this year. We are expecting a price correction. It would be very unusual for us to go into what is one of the largest recessions on record without seeing any correction in pricing across the real estate markets. Importantly, though, we are seeing differences across sectors, and this is very much mirrored by what we're seeing in the Iberian market as well. We're expecting the residential and the logistics sectors to be holding up far better than the other parts of the market. Office, we are seeing some decline there, but in all cases, this is a combination of yield expansion plus some rental decline. And then shopping centers, we're seeing a 25% fall in values on average across Europe in 2020. I think what I would stress in all cases, but particularly in the with shopping centers and offices, where we're seeing value decline, this is not every single asset will see a 25% fall in value. Certainly there are many different types of shopping centers, many different markets, and we do see quite a broad range of outcomes across different markets. If we turn now to the next slide, what this is giving us is a bit more information about our outlook for the Iberian market, and this is a longer term perspective, what we see over the next 5 years. And what this is showing is, look, yes, we do expect 2020 to see a sharp fall in capital values across most sectors, but we do expect to see a rebound in values as well. And I think there's a combination of factors. One, we would expect from the second half of this year, we would start to see economic growth returning to the market. As I mentioned, fundamentals are in far better shape than they were compared to previous crises. And I think importantly as well, on the capital side, we are expecting to see further yield compression over the coming years. So yes, some yield expansion this year, but with a combination of very high levels of dry powder, with a lot of central bank intervention, with the ever quoted lower for longer bond yield across many markets, we would expect to see further inflows into the real estate market. So a return to rental growth from about 2022, and then further yield compression, more than we were expecting pre-CV-19. And what you can see here across the Iberian markets are, on average, we're expecting these markets to be at least as good as the European average, and in some cases, particularly around residential and parts of the logistics market and perhaps Lisbon offices as well, we're expecting returns to exceed the European average. This doesn't necessarily mean we're going to come to an overweight call on the Iberian market. We would expect a slightly higher risk-adjusted return from the Iberian markets to reflect a higher level of risk that we see in Iberian markets, particularly some of the smaller cities like Lisbon, where at times there are concerns around liquidity there. But maybe just finally, I'm going to quickly canter through what we see as our top picks for the Iberian markets. First off, we've got Spanish logistics. Actually, this would be Iberian logistics, really. What I think everyone likes logistics at the moment. You know, you saw from our forecast, we're expecting the logistics market to be one of our top performers going forward, and certainly the Spanish market and the Iberian market is no exception there as well. As we see the acceleration of e-commerce, as we see very low levels of vacancy across this market, we would expect logistics to be an outperformer. I think the one thing, though, that I would stress on logistics, it still is very important that we fully underwrite our tenants for any investment in the logistics market. We've got to remember plenty of logistics is well connected to the retail sector. If we have any concerns about retailers and the solvency of retailers, we should be looking very closely at our underwrite of our tenants. But nonetheless, Spanish logistics, one of our top Iberian logistics, one of our top picks for the Iberian market. If we flick now to the next slide, residential. Residential, we have a very strong call on the residential market. We've got to remember that for many pan-European global investors, residential actually today is still a very small part of our portfolios. If you look at, say, the MSCI's PEPFI index on their balanced fund, we're talking sort of a 1 or 2% of those funds is going into residential today. We expect residential to, across Europe, but particularly in Spain as well, to grow as a much larger part of the investable market. We're seeing growing demand in the big cities for rental space, and we're certainly seeing the performance over the last three months would suggest that the quality of income that you get from residential is very supportive throughout the cycle. So we're expecting a large amount of institutional capital to be coming into this, coming into the residential market. What in particular, what we like at the moment is what we call commuter residential. So this is sort of it's somewhere between suburban and edge of city centre residential locations. Why do we like these locations? It's a combination of affordability for residents. Still, we're looking for areas with great connectivity. But if we are concerned long term about, say, more increase in working from home, for example, then perhaps these larger units, more family-focused units, will be more attractive going forward and have that ability to see additional rental growth. So certainly, for example, a good example here, the picture is Badalona, which is a city, a location sort of just adjacent to Barcelona itself. There we're seeing plenty of opportunities for outperformance of the wider residential market. And then last but not least, here we have new office locations, and this is perhaps a bit of a controversial one because certainly there are many question marks over office space at the moment. But we're not as a house saying that we expect to see the death of the office market. We certainly see a disruption coming to the office market, and as a share of the investable universe, we would expect office to become a smaller part of the investable universe. But nonetheless, we still see plenty of opportunities. Office will remain one of the largest parts of the investable universe. What we mean by new office locations here, we've got the picture is the 22 At district in Barcelona. These are not your traditional CBD locations, but still within the center of the city. These are still well connected. These locations, they're still accessible, but they're affordable. to occupiers. They tend to, in the 22 app, for example, you'll be seeing a rental level of around 20 to 22 euros per square meter, and you compare that to the CBD, which is getting closer to 30. You're certainly getting a discount in these locations, but it's more than just a discount. It's offering lifestyle as well. They tend to be more mixed use, these locations, and they also tend to have more modern stock as well. So if we are again expecting to see changes in demand and changing usage of office space, then the stock within these new office locations does tend to be more aligned with what we would expect for the future. So that was a very, very quick canter through how we're seeing the Iberian market. I'll leave it there. All I'd say though is plenty of opportunities, and keep looking at the Iberian market. We would expect it will remain very active for the foreseeable future.
Great, thanks very much, Simon. Lots of information there for us to digest, I think, and also to bring up in the discussion. Let's start just maybe with you, Cristina. I mean, there was already momentum in Iberia leading up to the crisis. How do you see the position now as somebody who's, you know, very much an important investor in the region?
Well, first of all, thank you, Maria and Simon, for the presentations, because I think they were extremely interesting, and they brought up a lot of issues that you know, that some of them I agree with, some of them I don't. The way I look at now at the opportunity in Spain is a little bit different as what we had after the previous crisis, right? To me, the main difference now is that you can no longer rely on a differential growth of Spain versus the other economies in Europe. Okay, I think when we were coming out of the previous crisis, and Maria showed that very well in her graphs, Spain went down dramatically more than other countries, and therefore the recovery was much, much stronger. I think now we are in a situation where most of the countries are suffering quite heavily, and we're all going to recover, hopefully, at a faster or a smaller or a slower rate. But I don't perceive now that the opportunity in Spain is as macro driven as it was before. And therefore, what you need to do is you need to be selective, and you need to look at two aspects, I would say. One is there any particular sector where there is a lot of distress and where we still believe very much in the long-term fundamentals? That is one way to look at it. Okay. And the second one is, are there any specific or specificities of the Spanish market opportunities that are going to accelerate, or where the trend underlying those opportunities are going to accelerate? And I think in the first bucket, I will put hotels and tourism. I think Maria said that. Tourism is a huge industry in the Spanish market. Our hotel stock is the largest in terms of sun and beach of all of Europe, with more than 500,000 beds. And we are going to see, unfortunately, distress there. Hotels have been closed, and even though now they are open, the speed at which people will return to the hotels will be slower. So, you know, we're expecting not only 2020, but probably 2021 to be well below to what we thought prior to COVID. So that is a sector where I think Spain offers tremendous opportunities with very, very good qualities. Some of the best locations in Europe for sun and beach vacation for the whole of the European consumers. And there's going to be very, very attractive opportunities, not only in terms of price, but actually in terms of assets coming to the market, right? So tourism is a trend that we very much believe in. We believe people will go back to traveling. We believe people will go back to traveling, you know, in a very narrow seats like we were doing before. And we believe that people, you know, will still continue to want to go on holidays and to hotels, right? So that's one big opportunity that we were seeing before, and that with COVID is going to be, I think, reinforced by virtue of making the opportunity itself slightly more attractive on the entry level. And then the two themes we really like in Spain, Simon has pointed at them. One is residential, rented residential. That is a trend that again is going to be accelerated by COVID. We believe that the economic uncertainty that we're living through, and that will not go away until next year probably. There's a lot of help in the economy, as Maria was saying, but I think when that help goes or stops, we need to see what has been the real damage to the economy. So people are not going to be willing to make big decisions or to take on big mortgages, right? So we think the appetite for rental is going to increase. And there was already a huge lack of residential under rent in Spain compared with other markets, and also a huge lack of affordable housing. Again, I think those two things Simon has touched on them. We very much believe that affordable housing is going to attract a lot of international investment, provided, of course, that as a country, and this is a plea to Maria, that as a country we offer a friendly and stable legal framework. Because otherwise, we've seen what has happened in some German cities, and we've seen how damaging it can be, not only actually for the investor, but actually for the people living in those cities, when the legislation doesn't welcome international investment for rented residential. That results in lower supply, and that makes the access to housing problem for people much larger, right? So we have to be careful about that. But if we don't make any silly moves there, I think there's going to be a huge opportunity there. And then the last point is, again, related with logistics. That's a sector where there's still a huge lack of supply. The way and e-commerce trends in Spain, which was already a country that was well behind the rest of Europe, are accelerating. We used to think that Spain would catch up with the European average in 5 years of e-commerce penetration. We now think it's going to happen in 3. And that's going to require much more logistics space. The way we like to play it is not in the big boxes space, but actually in what we call light industrial, which is really a combination of office and logistic, warehousing, but not only warehousing, for companies that is very close to the cities, and that we think there's going to be huge demand coming from e-commerce, and also potentially from companies. We will talk about offices, I'm sure, at some point, from companies thinking that they don't necessarily need to be have older people in the middle of the city. So to summarize, the way we play it is we look at the impact of COVID and think, okay, is there going to be distress or some window of opportunity in a sector where we think long-term will perform well? And that's maybe the case with hotels. There are other that maybe if we have time I can talk later, which is leisure assets. Again, all cinemas are closed, all theaters are closed, live events, live venue events, yeah? We actually believe that's going to come back as well, right? And then the other opportunities are the ones that we already saw before, and that with COVID we think are becoming even more attractive.
Okay, great. But I just wanted to pick up with you, Pedro, first. Looking particularly at the Portuguese market, in terms of the opportunities and the different ways in which the crisis has maybe influenced some of the trends for Portugal, what are you seeing, and what does that mean for you in terms of the opportunity for investors?
We still live uncertain times, so this is very new, I would say, for all of us. There is still some question mark for the future for, as Cristina was saying, how long this is going to be and how fast is going to be the recovery, etc. So I think there are still a very large of uncertainty for the future. Although, if we can make a brief all across sectors, we saying that up to now, the sectors that are suffering more are, for sure, health clubs, shopping centers, cinemas, of course. And so in some of these, especially cinemas, the question mark if there is going to be a future, I think is a very good point regarding, you know, Netflix and other kind of things. So for sure it's going to have entertainment, but really cinemas, I don't know if it's going to be the trend. So common cinemas, if it's going to be the trend for the future. For sure also that logistics is what was the ugly duck a decade ago. Now it's a very sexy sector. Then maybe we move to other things that are more, I would say, speculative. So, and I'm very glad to see in the TWS slides that Lisbon is outperforming Europe, Madrid and Barcelona. I think it's the first time in my life that I've seen this, you know, so strongly above. And yes, I mean, one, there is before COVID, there was a strong demand on offices, and now it's a kind of question mark whether, you know, if co-working is going to survive and is going to be the same way. But I'm a little bit, I would say, realistic / optimistic for the future, in the sense that either shorter or longer time, I would say that probably in 1 year time, we are going to become in a kind of completely normal or a kind of new normal where people have to have some mitigate measures, but they're going to live almost the same way. So really the sector that I think is going to be affected more as a switch for the future and as a disruption for the future is the kind of, for example, business hotels, where, I mean, all of us probably, we would be in a conference, in a meeting room today, and now we are not. And I'm not saying that we are not going to be anymore, but for sure a very big rate of this kind of either events or business meetings are not going to occur anymore. And so in that sense, business hotels and of course some business trips on you know, air traveling, etc., is going to be is going to have a dramatic change. Apart of that, I would say that probably Iberia, Portugal and Spain together, we are going to be more strong in the future, in the sense that also because of what I was saying, more people from the Nordic countries are going to like to live in Iberia, doing teleworking for, you know, Sweden, Denmark, UK, etc., and can be with a very good life, cheaper life as well in the southern countries.
Okay, that's good. I did a quick poll as well during this. Thanks to everybody for voting in that, which I'll share now as well, which was just, are you today more or less optimistic than you were at the end of March? More optimistic is 40%, the same is 38%, and less optimistic is 22%. But Pedro, whilst you were speaking, actually people became more optimistic. So I think that's, you know, positive for you, I think. Good. Jose, I just wanted to pick up with you because obviously Grupo has a lot of, you know, focused across assets, obviously, but you're looking at, you know, both logistics as well as office, as well as retail. What's your sense of that? And I suppose, how do you see particularly retail? And maybe it would be good, because I know that you're also in the sort of shopping council there. So what's your sense of how the industry is feeling? And also, I suppose, what's your sense of the prospects for it and how you see retail especially developing? And then we'll pick up on some of the other sectors, but I think this is an important point.
We understand that the moment is very complex, as we all know, and we have been always, and we are going to be very prudent. We are not going to jump into conclusions, because we have to analyze very quickly and in depth what is happening, how the customer is reacting to the reopening. It is only 1-2 weeks experience of the new reality. So we have to take the data and we have to make our own analysis. What we think in this sector that you mentioned, and in all the sectors, is that we have to do is fasten our seatbelts very strongly, because we are in front of a very long and winding road, as the song of the Beatles. We need a very good car, which is the company that we have been strengthening in the past 5 years, and we have a very good driver, which is the manager. This is going to be a moment in which we are going to see the differences between companies and between managers. Let me to give you an answer on the retail and in the other sectors. Let me go a little bit before, because before of this crisis, we saw that the trends were changing in all the real estate sectors and in all the sectors in the economy in the world, in fact. We are more in a world of flexibility, of living, working and buying. We are in a world of technology where data is fundamental. We have to know the client and we have to know the user. Sustainability is the main element. It is the real defining challenge, the climate change. We need to work for it very strongly. It's not only a label in our GR accounts. It needs to be, you know, the key element. And also the experience. The experience started to be in hotels and retail, and now it's in all the sectors. Because you need experience in logistics, you need experience in offices, you need experience in co-working, co-living, and all these new formulas. What I feel is that this, the effect of this crisis is going to be strong. In comparison with the 2008 crisis, I agree, of course, that the origin is not the same, but the result could have some similarities. And we are going to see that there is going to be a selection between winners and losers. The three sectors that I lead in Grupo are, as you mentioned, are retail, logistics, and offices in this order of magnitude. In retail, we manage La España, which is the leading company in Spain. It was founded in 2014. We saw the opportunity to buy good, resilient assets coming from the past crisis and transform it into new one, reinforce and get better of services and tenants. And the experience has been very, very positive. But it is true that this is a sector that it has been strongly questioned in the past 3-4 years. There was, and it is still there, a very high uncertainty of the impact of online shopping. And this has created a negative global state of opinion. And it is an opinion. It is not only facts, but it's also kind of opinion that it is very difficult to change. I personally, and we have been explaining that the future is not only online or only physical. The future is omni-channel. This is a good example. We are omni-channel today. We are online today. In past 3 months, we were all together. The real asset work is online. The property, Iberian property is online and physical. So the combination is the real important target for all of us. We have seen also that in the last 5 years, all the centers have been performing quite well in Spain. We are seeing 5 years of increasing in sales and visitors. And this is maybe because this is one of the most flexible and adaptive ideas, formulas in the real estate. And we have invested a large amount of capital in trying to get better, improve, and update all the assets. Let me say one thing, because maybe it is the moment to say again that yes, we know what is happening in the UK, but there are many other countries in the world where the physical formulas are strong and successful. The UK market has some characteristics that maybe are different from other countries, and not everything what is happening there is going to replicate exactly in other countries. And this is important because the capital is coming from the US and from the UK, and this is affecting the retail industry. Just to complete this first speech in values, we forecast, we have seen the presentation of Simon, and what we have in mind is that we are going to have a first controlled impact in values, and afterwards we are going to have a strong polarization between good and bad, and the good centers probably are going to maintain capital values or be less affected, and the bad centers are going to have a long period of adjustment, because the main important point for us to calculate value is the sustainability of the income stream. If you are able to demonstrate to investors, analysts, and the rest of the community that your income stream is stable and strong, your value will be really reinforced at the end of this. So this crisis of coronavirus and COVID-19, maybe it is going to be good to have a segmentation of the market, put the goods here, the non-so goods over here, and maybe change the global point of view on retail. It is not going to be the same to have a shopping center with Zara, with Primark, with MediaMarkt, that if you don't have them. So this is what is going to create these segmentations that I mentioned before. And the value is going to stabilize. In terms of transactions, to be honest, I don't see many investment in the coming months. I think that this adjustment and segmentation is going to happen in the next 12 to 18 months. Then we forecast that at the end of 2021, we are going to see the retail investment sector coming back. It is true that there are formulas in the market that are really in fashion today, that all the assets with food component, we are seeing in Spain some portfolios of a very important brand of supermarkets, and the prices are being very, very competitive. In logistics, just to finalize very quickly, we see a strong value. We don't forecast a capital value decrease at all. We think that there are many challenges in this sector because we want to see how the rents are going to really increase, not only to forecast in an Excel page. We know that the margins of the distribution companies are very tight, and they need to gain efficiency if we want to get higher rents. So I think that the thing that they need to do it is to invest more in technology and artificial intelligence to reduce costs, and in some cases start to make money, because some distribution companies are not making money yet. In markets, again, as you said before, there is a lack of good projects in Barcelona, Valencia, Madrid. We see that there are a lot of construction and the vacancy is very low. So with this increase of demand, prices are gonna get higher. In offices, I'm going to be brief because it's the activity that we are working less in these months, but we see a strong demand. We are seeing operations. We are seeing interest of the investors. The CBDs of Madrid and Barcelona are full occupied. So this is very positive. We have to know right now what is the real effect of telework. It's the thing that I am always thinking, because as many others, some of you are now in your houses, and I have been 3 months in a co-working, but the co-working place was my house. My wife, my elder son, and I were together working in the same co-working place that was, working in family. This has been one of the positive points of this terrible issue. And this is all from my side for now.
Okay, that's great. Questions coming from Tiago Fonse. Thanks for that, Tiago. Which is, are the office centres at risk? Does anybody have a feeling, I suppose, that there's a more broader issue in terms of the offices? I mean, Simon, obviously, you're looking not just at the I suppose the CBD offices, but also different positions for offices, new areas for offices. So from your perspective, do you see there being issues for office, those big kind of CBDs for office, or how do you see that?
Less CBD, less the sort of near CBD locations that we're talking about. But I think my biggest concern would be on sort of peripheral office locations, the edge of Madrid, the outer town, Barcelona, that never really recovered that strongly from the financial crisis. So you look at those today, still high levels of vacancy. Yes, affordable rents, but you haven't seen a huge amount of demand sort of driving down the vacancy in those locations. And then when you look at the type of activity that tends to go on in those peripheral locations, that's the sort of activity that can easily be transferred towards sort of home working. It's less collaborative space, it's more sort of functional space. I think that's where our biggest concern would be.
Okay, good. I just wanted to pick up with you, António, just in terms of sort of activity in the market. And we've had a question come in, thanks very much for that, on student housing, healthcare, and I'll pick that up as when we look at alternatives. But António, what have you been seeing in terms of market activity? Deals coming through. What have you been seeing?
Let me come to the last comment about co-working and stuff. Of course, they are challenged because we need to create more social distance. But I really believe that office flexibility and commuting between working at home and co-working could be a successful model in the years to come, in opposition a very standard office 9 to 5 that we were used to check. I believe architects and people who designs the new buildings will be challenged to find homes that allow office space that allows more flexible uses. Many thanks for the opportunity to show a little bit our platform, Iberian Property. I prepare a few texts, and just to say that coming on our tool, Iberian Data, where we collect from 3 years from now all the deals that we know that come to the public. From January to March, we record 88 deals. These 88 deals amount for 4.5 million, with a reasonable spread across all Iberia, and with a very strong activity in other Spain locations like Seville, like Valencia, like many different cities, a part of course, Madrid, Portugal, and Spain. And here you can browse some of the most important deals, like this one from Patricia, by Pan-European logistic portfolio, with a huge amount of 213 million in different locations of Spain. We work at quarter in Madrid, and very diversified deals of different sizes, with an important hotel in Madrid for 222 million, 220 million. A different story is what we saw this last quarter. Of course, the quarter is not closed, and many of the deals, we know them also through our partners, the agents, and with the close of the quarter. So this is very early stage. So these numbers will increase, but we have already 24 deals from April to this date, which shows that, of course, activity slows down, but still deals are coming. and deals are confirming and they are happening. I'm just browsing the three biggest ones, like AXA investment managers buying 219 unit affordable housing rental portfolio in Madrid for 150 million. That's quite significant. And into that concludes sale of Porto Venezia. In fact, this was an operation that was already agreed last December, but due authorizations and regulations only was closed effectively in April or May. And DWS, from our friend Simon Wallace, bought two real estate projects under construction, 200 million into real estate projects.
Okay, good. I wanted to pick up a little bit on some of the alternatives. The questioning about student housing, healthcare in Iberia. What's the sense? I mean, Cristina, from your point of view, how do you see those alternative markets? We've already mentioned a little bit about the residential side, but how do you see those? Because there's obviously been a growing focus on areas like healthcare and senior housing. And obviously things like student housing have been growing for a period of time. But what's your sense of those alternative sectors?
We are currently investing actually in healthcare, in nursing homes, okay? We have 18 nursing homes right now under management. So, we've been very busy during the COVID crisis. We've been lucky in the sense that we've managed quite well through the crisis. But look, Richard, there's a huge lack of offer. Population is aging very fast across Europe. It is also aging fast, or probably faster, in the Spanish market. Spain has one of the oldest population. And so we think that everything that is related to healthcare, it's a huge opportunity. Nursing homes. A lot of the stock is in the hands of government owned and is government managed. But again, going back to where we are, with the amount of money that is being poured into the economy, the amount of debt that countries are accumulating, Spain in particular, this is another area that we're going to need public-private cooperation. We're going to need private money to build all the nursing homes that we're going to need for the Spanish population. So huge opportunity there. And again, right now the legal framework is quite positive, and we hope it stays. We hope it stays like that. But there are a huge amount of other senior living offers that do not hardly exist. Senior villages do not exist. I actually believe that Spain could become a little bit like the Florida of Europe, not only for vacations, but actually for older people when they retire, when they're still healthy, between their 60s and 80s, to come to Spain and spend here, I don't know, 10, 20 years. There's very little of that. There are some assets, but very, very little, and a huge opportunity there. And then the area of co-living, of how we believe that the healthcare system will necessarily need to keep people in their homes for longer and provide healthcare to them in their homes, because there's not going to be enough beds in hospital, there are not going to be enough beds in nursing homes, and therefore, changing the way we provide healthcare to our elderly people by allowing them to stay at home, that will mean building those houses in a slightly different way, with more common areas, for example, with services that are readily available. So it's a sector that we like very, very much. We think that COVID may impose some minimum standards, maybe some standards that are not being complied with by the smaller offer. Again, that's going to be an opportunity for international investors and for institutional money to acquire some of these assets that the owners do not have the capital necessary to upgrade them to the standards that are needed now. So we do see there buying opportunities, M&A opportunities, and it's a huge area for us, and I think we're going to see a lot going on. Student housing, we are a bit more skeptical because just because there's been a lot of new supply that was coming into the market, that was being built. And I think you need to be more selective. We think some locations could be a little bit overcrowded, but certainly Spain attracts a lot of international students. Mobility inside Spain is growing, and more Spanish universities are offering courses in English. So when I look at the UK and Brexit, and my children went to school in the UK, so I'm a big fan. But I think I think foreign students are going to also look outside the UK to other European countries that maybe before they were not looking at, and maybe now they will consider. And I think Spain there has a place to play. So again, student housing, you have to be a bit more selective because a lot of investment has happened already, but still good demand. And healthcare and everything related with the aging population, we are big believers.
Okay, good. And that I think picks up on a lot of the kind of trends around that acceleration of markets that we've seen, where senior housing, healthcare coming more to the attention and coming more under a focus, particularly because of the crisis. I just want to pick up a quick poll in terms of valuations. And this one is, when will valuations in Iberia return to December 2019 levels or beyond for most sectors? And I'm allowing the panelists to vote on this as well, because it'll be interesting to see what the response is. But I think that's going to be a really interesting thing to watch, just to see how these valuations do change and come back. One thing that I particularly wanted to pick up was maybe with you, Jose, just looking at the sort of market fundamentals. I mean, obviously it was very positive for Spain before, and you mentioned there that there's going to be a lag in some sectors. But do you see that idea that the fundamentals were positive and that over a period of time, whether it may be June 2021 or December 2021, that ultimately that strength will continue through because it's a different kind of crisis?
Yes, well, maybe let me go through again to the three sectors that I have covered in my previous commentary. Let's start with retail. I think that the fundamentals, are going to be temporarily affected. So we are going to see what is a fact now, that in our case, we are negotiating with 700 companies the rent of the closing period. Okay, and this is on the table, this is real, and this is happening all around the world. So this is going to have an impact of this closing period. But if you see a little bit farther to the end of the year, I think that most of the investment community assumes that we are going to make an effort to support all these people, because all these people are our key clients. They are paying all the rents. And we are not going to see a full recovery of visitors and sales until probably Q1, Q2 next year. I can give you some numbers of what is happening now. In average, in the Spanish shopping centers, we are having around 70% of the previous number of visits. I mean, if you say 70% in 2 weeks, it seems to be very positive. But at the end of the day, what we need is 100, because we need to sell the same amount and the same turnover in all the shops that we were doing some months ago. There is a peculiarity there. It is that the visitor is a buyer. It is not, somebody that is going to the center to spend time. It is a very focused customer. So we are seeing that this minus 30% in visits, in some centers, we are seeing a plus 5–10% in sales. We need to take time to analyze this, because I do not want to be, to jump in any kind of conclusion, because this could be, the effect of many different things, psychological, the position of the customer, then the need that the Spanish people has to get out their houses, find people, meet people. We are, Homo sapiens is a social animal, but the Spanish and the Portuguese as well, we are very, very social. We need to get out of our houses. So we need to see if this trend of reduction of visits but increase of sales is going to be sustainable for a number of months. And I go to these 2 points because these are the two fundamentals, the real fundamentals of the value of a retail asset: sales and visitors. I cannot be, always focused on what is going to happen with the price of money, with the vision of the, analysts and the stock exchange experts on retail. I want to be absolutely focused on NOI, and NOI is coming from sales and visits. And I think that hopefully, as I said before, in a period of 10, 12 months, and of course, as soon as the machine is in place, we were going to go back to the previous numbers. It is true that the online, has changed a lot. We have seen an acceleration, new people buying online that they haven't done before. The aging segments of the society, getting into online sales for the first time. So there are many factors, but at the end of the day, I think that this is going to be stabilized, let's say mid next year. And also with the thing that I said before, we're going to have the good and the bad. Okay, and the ugly, like the film. The good, the bad, and the ugly. The good are going to be stable, the bad are going to struggle, and the ugly, I do not have any comment. But anyway, in other sectors, I think that the fundamentals in logistics are very, very, very strong. You have demand and you have offer. The increase in online, it is being very important. We see that there are a lot of demand for new space. We are developing 4 schemes right now in different places in Spain, and we are seeing a strong demand. But I have to come back again. Logistics sector is not as sophisticated as retail. They need to invest more in technology, because if they want to increase margins, they need to make a more technological management of the delivery and returns, because this is another element. The reverse logistic is going to be more and more important. I don't know your cases because there is no data in the market, but from my personal experience, if we buy 4 or 5 fashion apparel, clothing or whatever, we return 2-3 on average. So this is going to be very important, last mile and returns management. So the fundamentals of logistics are, very strong. We are going to see a lot of interest of, operators and also investors. The only problem is that, investors, we are like, we always move in groups. We go to retail, everybody to retail. We go to offices, everybody to offices. And then in the last 2 years, everybody to logistics. And we as developers, we are seeing that the prices of land are growing very quickly. The cost of construction is being stable after, a sensitive increase in the beginning of last year, but now it's more or less stable. And the rents are, growing, but not too much, not that much. I see that forecasts of some, whatever analysts, and that they said that their rents should have been higher. But I had experience in previous companies, in previous adventures of developing logistics, and I saw higher rents in 2007 than today. I don't think that their rents have already recovered. So with all these elements, it is very difficult to make evaluation. You do not have comparables. Fundamentals are very, you need to make an interpretation of all of them. And it is a real challenge for all these evaluators, the consultant companies, to be, really, it's very difficult, really inform and really have a global view on what is happening. I think that it is a moment in which it is very important that there is a coordination of all these consultants, because the value of the companies in some moments are in their hands. Financing is very important. Loan to value is a critical point. And we need to see a very consistent valuation now in mid-year and at the end of this year. Probably we will have more light at the end of the year, and in that moment it will be a little bit more easier to make these valuations. But I think that maybe there is a risk of overreaction in the side of valuators, looking at the assets and looking, at the potential liquidity of these assets and the price of them in a potential transaction when there is not market. So it's a complicated moment as well in this side.
Okay, I'm going to come to you in a second, Pedro and Simon, but I just wanted to share the results of that. So valuations in Iberia returning to December 2019 levels or beyond for most sectors. So December 2020, 3%, June 2021, 31%, and December 2021 or later, 67%. So the majority thinking that we're going to have this in terms of valuations, at least up until December 2021. For the majority of sectors, obviously there would be differences then if we did it by sector, I'm sure. But Simon, just from your perspective, there's been a couple of questions coming in on the Q&A here, which have been around, alternative uses for retail shopping centres, but also that, big offices are a thing of the past, that there's going to be a big substantial change. How much do you see those things in terms of the influence? And I suppose you're looking across the globe as well as pan-European. But what's your sense of those kind of broader trends, just to pick up on some of the points that we've had there?
Yeah, they're very good questions. And I think the first point I'd make is when you're in the middle of a crisis, it's very easy to jump to the extremes in your analysis and say, retail is dead, the office is dead. We don't, we will never go up a skyscraper again because we can't use the lifts. I think that to me is the wrong interpretation of, and it's too soon to make any broad sweeping conclusions like that. As I say, I think, yes, we will see adjustments in the amount of retail going online. Yes, we will see adjustments in how we use or how we think about office space. But as I say, I wouldn't want to go too far when we're only 3 months into this crisis. If you said the same things to us in February this year, we'd think you were peculiar. So I think we need to be a little bit calm about, and sort of take some time to reflect on that. But I think you're right in terms of some of those broad trends we were seeing for a number of years now. So in terms of intensification of our office usage, yes, that's been going on for a long time now. Expect that to continue. So the reorganization of office space, more collaboration, more meeting room space, used in a different way, absolutely going on. And I think that pushes us towards a certain type of office space. I think retail, absolutely, again, repositioning retail to both meet customer needs, but also provide alternative usage makes perfect sense to us. I completely agree with what's been said before. The best retail will continue to have a central function in the lives of retailers and consumers. I think it comes with difficulties. Don't get me wrong. If you're talking about creating experience, then that does require additional capex, and it actually can often lead to shorter lease legs. So there are difficulties around sort of your sustaining your income stream, but nonetheless, I completely agree. The best shopping centres, those both regionally dominant, but sometimes even locally dominant shopping centres should continue to do well. Thinking about including residential in sort of a retail location, or perhaps shifting towards more leisure or food and beverage. Absolutely, we've been thinking about that for a long time. And then maybe just sort of touching upon some of I'm going back a few questions, but touching on some of the niche sectors that we were discussing beforehand. I think this is a really interesting area for us going forward. And again, we would expect it to be a growth area. Senior, health, student, all of those areas are important growth areas for particularly the Iberian market. I think it depends what sort of investor you are today. As was said, as Cristina said, there is a lack of product today in this market. So if you are an investor who is willing to, say, at least forward fund, but perhaps develop yourself or to work with new operators, so moving up the risk curve, let's say, then those sectors can offer some great opportunities. If you're more of a core player, it is harder to get into those markets. Quite often the unit sizes are small. Quite often you are forward funding. We would forward fund, that's for sure. But nonetheless, you can understand why some investors aren't yet into the niche space, because the product isn't yet there for investment.
I'll just share the results here of that poll on distress. Do you think there'll be more opportunities in distress over the next 12 to 18 months in the Iberian markets? 85% say yes, 3% say no, and 12% say they'd be about the same. So that I think is an interesting view on that, especially given the view that people are thinking that it's going to go. Valuations may not pick up for some sectors at least until December 2021. Pedro, what's your sense of the markets at the moment, particularly looking at that distressed, the result that we've got there with 85% of people expecting there to be more distress coming into the market. It's an area that you're also active in. What's your sense of the opportunities there? Is that something that's going to appear more like in 12 months' time as the economic crisis begins to work its way through? What's your sense of that? And also, I just wanted to pick up on pricing and valuations, just whether or not you're seeing those differences at the moment in the current market in Portugal.
First of all, I would say usually UK people are much more, very direct and straight on to have the decrease on the valuations and then the comeback shortly. And for example, when we assist on the results on MSCI, we saw that very quickly when we see UK results and Ireland results comparing to Southern European countries again. Usually Latin people and Latin countries are more deferred guys, so things happening, unfortunately, a little bit late, sometimes with worse results. Although nowadays we cannot say that. I think we are more on the top of the train, in the sense that some politicians in UK and US put us more likely to be the rational guys instead of the emotional ones that used to be some years ago. So in that sense, I would say that probably what is going to happen, we are going to assist on distressed portfolios more starting after the year end, because for different reasons. First of all, things take a little bit longer to happen. We are going to see that, but this is not happening yet. Second, the governments are giving deferred payment schemes to the lenders, not only in the banks for their mortgages, but also for the rents on the shopping centers and some other sectors. And so in that sense, we could say that things are, the measures, we are going to see if the measures take effect when the defer finish. And so in some cases, we are going to see that probably the tenant didn't pay the rent now and is not going to pay the rent when the deferred payment finish. But for the moment, it's still a kind of, an asset on your balance sheet that you are not completely sure if you are going to take it or not. So, and if you are not going to take it, then you might have a distress at that time. I would say that, so for sure, the first wave would be after the year end, and probably the second will be after summer, mostly regarding tourism assets connected, that some of them are going to wait until the next summer for recovery, and the ones that are not going to recover, probably they will suffer after the finish of the summer 21. The good news is that, well, interests are never been so low, and so what we can assume in a world of uncertainty is that interests are going to stay low or even lower, but for sure for a longer period of time. And so this is going to allow the economy to recover, because it will, help a lot the investment to come back, and so to even from some of these, I would say, cleaning accounting balance sheets, it's easily with interest rates at the lower level. And also, of course, because all of politicians are going to want that, because of the big issue of the public debt, that is the big issue, I would say, in Europe. So the bigger difference in Europe is that, comparing to the financial crisis, at least up to now, it's the private debt is much lower what it was before the global financial crisis, while on the other hand the public debt is not that low, because this crisis is it's not financial, is pandemic, so it becomes more a global debt, public debt. And so I would say the ECB is more prepared to deal with this kind of distressed assets, and to the problem of distressed assets on the balance sheets of the banks. And so they are going to put more pressure for the banks to clean it as soon as possible. And so that will, I believe, that is going to make the market recover quickly, because banks are not going to stay longer with their assets just to try not to have losses.
What's your sense, and happy to pick up other people's views of that financing side, loan to values? How do we see that at the moment?
I think, as I answer in the chat, we see both investors and banks turning more cautious. So I think for new transactions, we will see lower LTVs, definitely. That's our view. And even we're seeing investors that are thinking about, starting with all equity, just not to depend on the banks. The banks are very, very cautious, okay? And so for very safe prime assets, fully rented, fine, you can get financing. Anything that has any risk to it, that doesn't have an income stream already very visibly coming, we see the banks are much more hesitant. So for new investments, anyone that has equity that does not depend on raising financing at the same time will be at a huge advantage. That's what we think. For existing assets, of course, we see banks pushing to lower LTVs. They're forcing companies to sell. We didn't talk about this, but we see an opportunity. I kind of mentioned it when I was talking about assets coming to the market that otherwise wouldn't have come. Kind of sale and leasebacks of corporate selling assets that otherwise they wouldn't have, just to lower down their overall debt level. And I think banks would welcome that. And of course, if you already have a financing, you're going to negotiate with the banks, right? But overall, we see a world of much lower LTV going forward. Again, I think a lot of the panelists mentioned it. There's so much uncertainty still around the speed of the recovery, the shape of the recovery, that I think everyone wants to be very cautious, and banks know that there will be some distress coming, and therefore they want to minimize that. And with new transactions, we're seeing them quite conservative now.
We will see again a very big flow of liquidity, either by ECB or the new bazooka from the European Commission. And as we've seen before, many of these liquidity will look for a safe place to be, and that is real assets for long term. So looking a little bit ahead, are we creating an even bigger liquidity trap and more demand by real assets, including, of course, a real estate, and that can make a huge difference. Simon?
It's a good question. I think if I was underwriting a deal today, say with a 10-year outlook, I would be assuming a lower exit yield than I would have been 6 months ago. So I agree. As a result of this crisis, that the ECB and the Federal Reserve and other central banks will, have lowered interest rates, have boosted monetary, have loosened monetary policy substantially, far more than we were expecting before this crisis. And given as a result of the debt overhang that we're going to see throughout the world, it seems very, very likely to us that interest rates will, and that liquidity will remain for many, many years to come. It will take a long time to unwind these debt positions. So will that force down real estate yields? We think it will. There's a high probability of that, because certainly when you look at pricing or the yield on real estate and compare it to other asset classes today, particularly against other fixed income assets, whether that be corporate bonds or whether it be, say, a government bond yield, real estate looks attractively priced. Can that be sustained for a long period of time? I think if we look at a number of examples, whether it be Switzerland or whether it be Japan, or just what's been happening in countries like Germany for a number of years now, is a real estate yield below or at or below 3% realistic, and can it be sustained? Yes, it can. Yes, it can. Certainly, if monetary policy and other fixed income assets continue to yield such low levels for a sustained period of time. I think what happens is, we all have this mental flaw quite often about where a property yield should be. And I think we've been through it, and a number of these flaws a number of times for the past few years. Initially we all said, okay, can't go below 4. 4 is too low, and then we smashed through 4, and then we're saying, oh, can't go below 3.5, and we did that. Could it go? But could, say, a prime, I don't know, office yield go well below 3% and be sustained below 3% if you've got a good long-term, good quality income? Look, if a government bond yield is barely yielding a positive return, that still makes the office look pretty attractive to me.
Richard, let me follow and add on what Simon has been saying, and let me share one quick thing. That's housing market in Portugal, and I have two nice figures to show, and one of them is the number of transactions. So this is an index for number of transactions, which shows that if June 2019 is 100, we drop to half of sales, but still happened half of sales. And then this figure recover to 30% drop. So number of transactions have dropped, but not dramatically. And prices, indeed, of course, didn't go up, but they are not dropping usually. So they stopped to grow, but we do not see an evidence of huge discounts on the sales made. And my appreciation is that we have this very up-to-date on Resi, but even on the deals on commercial property, we do not see by now huge drops of value, because leverage is not as strong as it was 10 years ago. There is more own capital, so people is trying to look a little bit ahead, as Simon was saying, and they do not see a fundamental reason why to sell today. And because leverage is not as strong as it used to be, so people do not feel so compelling to sell on a discount. So perhaps, just perhaps, Simon's initial view and some of the comments of the big value drops 15, 20, 25%. Maybe a little bit too dramatic. And if you look to stock indices, if you have a basket of shares, and if you are more or less luckily enough, you are now returning to where you were in March or in the beginning of the year. So my question is, how serious are we about a serious drop in values?
I think it's important, though, that we split out the long term and the short term. In the short term, we've all said it. There is a much bigger increase. There is a huge increase in risk and uncertainty at the moment. And if you're an investor, you should be getting rewarded for taking on that additional risk and uncertainty. And we've seen with things like collection rates, and we've seen with things like we would expect to see rental adjustment in this market. You should be getting compensated for taking on that additional risk. Yes, whilst over a 10-year horizon, we would expect to see a lower exit yield. I think in the short term, there are good reasons to expect that you will see disruption. Great, if you've got a 20-year let building in the heart of in the best location with the best tenant with a great covenant. Let's say you've got not to advertise, but let's say you've got an Amazon shed which has a great covenant with a long lease. Then fine. I think it would be maybe realistic to assume no rental and no value decline, or potentially even positive value increase. I think outside of that sort of super prime bucket, it makes sense that you would see, in the face of what we've got to remind ourselves is an exceptional recession, that you would see some value, you would see value correction across the market in general.
Interesting point here. Thanks, Goncalo, for this in the chat. For years to come, it'll be challenging for investors and property owners dealing with higher levels of debt, inflation risk, and occupier uncertainties. Sale and leaseback operations may surge due to huge short-term dry powder and financing need for operators. Interesting, because we've already seen that a little bit in the UK with some of the retailers doing sale and leaseback on some of their logistics side. Higher yields, lower capital values, chance for some investors to bet on a long-term capital appreciation. And just interesting picking up that point from you, Simon, there about longer term. And I'm aware that longer term is not something we've got left in terms of this seminar. We're very much into shorter term aspects now. So I just wanted to just quickly pick up on everybody from, I said at the beginning that we wanted to look at some of the challenges, see where we were in the market, look at the outlook for it, but also focus on the opportunities. So let's just pick up on the opportunities very briefly. Let's start with you, Pedro. Where do you see the opportunities at the moment for investors?
I would say that one, logistics. Second, this sale and leaseback operations, where also we can include some private portfolios that now they are with lack of money for their activities, and they need to sell some of their savings that they did invest over the last couple of years, and also probably some global investors that they have allocate a part on real estate, and now with the decrease of values on the bonds, they have to sell some real estate assets so that they have the same allocation toward real estate. Okay,
good. Jose, what would be your investment tip for people?
I see the value of the companies of real estate that are quoting in the market, and they are, the discount is absolutely crazy. They are seeing discounts of 50% or things like that. I mean, it is rational. But anyway, when I see big companies of all sectors quoting in these levels, I think that there is a fantastic opportunity for money. Also, I think that there is going to be an opportunity in the opportunistic segment of all sectors, in loans and approaching to the financial institution and also to the equity investors that they have done a lot of work in the past 2 years, and maybe they could have some help on investors and professionals or industrials that can help them managing their properties that they have financing. and these are the opportunities. I mean, the segments, you know, as I said before, logistics is, you know, from my point of view, logistics is, you know, the blue eye sector. And also, but I think that the alternative that you mentioned, Cristina and Simon mentioned before, you know, related more to the golden age and all these things are going to be very important, hospitals and things like that. And also, I will never forget good offices, good retail, and good hotels. This is going to be a good bet for the near future.
Okay, good. Simon.
I think he's already in my presentation. So for the normal core investor, I'd certainly say the logistics, the residential, and the new office locations. I think, again, I would agree with Cristina there as well, that for those investors willing to take a long-term perspective, I think the hotel market still certainly offers opportunities.
Okay, super. Cristina, last word to you.
I think, as I said at the beginning, for different reasons, but we think hotels, particularly leisure hotels rather than business hotels, offices, again, great locations, very premium asset, yes, but secondary assets, I'll be more careful. Rented residential, light industrial. In the world of logistics, we prefer to big boxes, and then healthcare. And really, for us, the way we see this is, I fully agree with Simon. We are going to continue to see a lot of money coming into real estate. So really, the way we see this time that we are going to see some sale and leasebacks, some assets coming to the market, we see it as an opportunity to acquire those assets at maybe slightly better valuations. You know, in our view, many assets had gotten very, very high in prices because of the liquidity tension that we all mentioned. We think long term, as Simon said, you know, the premium of real estate versus bonds still makes sense. So I agree with you. We're going to continue seeing yields coming down. And therefore, this is, I think when I say this is more the next 12 months, next couple of years, I think it's a great opportunity to buy high quality assets at slightly more reasonable valuations.
That's super. Thanks very much to everyone for joining us. Thank you to all of the speakers, the presenters. Thank you for your questions and also for your interaction in terms of the chat and the poll. Very interesting. You can pick up all of the presentations on our website shortly after this briefing. I'll also send a note round to everybody to say when those are published. That's on investmentbriefings.com. Look forward to seeing you at the next session. I think we're next looking at senior housing in France, then residential in Germany, and then from the week of the 6th to the 8th, we'll be focusing on the broader outlook in terms of beyond the crisis and how we see that both for sectors but also for most of the pan-European markets, and we'll also have specific ones on Asia and on the US so that we can also get a kind of global view in terms of how the market is feeling and hopefully share that with all of you. But for now, thanks very much for joining us. Stay connected and stay safe. Thank you, everybody.